Good afternoon. I'm pleased once again to share a meal and some thoughts with the Economic Club of New York. I'm going to focus today on the economic and financial challenges we face and why I believe that we are well positioned to move forward. The problems now evident in the economy and the markets are large and complex. But in my judgment, our government now has the tools it needs to confront and to solve them. Our strategy will continue to evolve and be refined as we adapt to new developments and some inevitable setbacks. But we will not stand down until we have achieved our goals of repairing and reforming our financial system and restoring prosperity. The crisis we face in the financial markets has many novel aspects, largely arising from the complexity and sophistication of today's financial institutions and instruments, and the remarkable degree of global financial integration that allows financial shocks to be transmitted around the world at the speed of light. However, as a longtime student of banking and financial crises, I can also attest that the current situation has much in common with past experiences. As in all past crises, at the root of the problem is a loss of confidence by investors and the public in the strength of key financial institutions and markets. The crisis will end when comprehensive responses by political and financial leaders restore that trust, bringing investors back into the market and allowing the normal business of extending credit to households and businesses to resume. In that regard, we are, in one respect at least, better off than those who dealt with earlier financial crises. Generally, during past crises, broad-based government engagement came late, usually at a point at which most financial institutions were insolvent or nearly so. Waiting too long to respond has usually led to much greater direct costs of the intervention itself, and more importantly, magnified the painful effects of financial turmoil on households and businesses. That is not the situation we face today. Fortunately, the Congress and the administration have acted at a time when the great majority of financial institutions, though stressed by highly volatile and difficult market conditions, remain strong and capable of fulfilling their function of providing credit to our economy. The prompt and decisive actions by our political leaders will allow us to restore more normal market functioning much more quickly and at a lower ultimate cost than would have otherwise been the case. Moreover, we are seeing not just a national response, but a global response to the crisis, commensurate with its global nature. The financial crisis has been with us now for more than a year. It was sparked by the end of the U.S. housing boom, which revealed the weaknesses and excesses that had occurred in subprime mortgage lending. However, as subsequent events have demonstrated, the problem was much broader than subprime lending. Large inflows of capital into the United States and other countries stimulated a reaching for yield, an underpricing of risk, excessive leverage, and the development of complex and opaque financial instruments that seemed to work well during the credit boom, but have been shown to be fragile under stress. The unwinding of these developments, including a sharp deleveraging and a headlong retreat from credit risk, led to highly strained conditions in financial markets and a tightening of credit that has hamstrung economic growth. The Federal Reserve responded to these developments in two broad ways. First, following the classic tenets of central banking, the Fed has provided large amounts of liquidity to the financial system to cushion the effects of tight conditions in short-term funding markets. Second, to reduce the downside risk to growth emanating from the tightening of credit, the Fed, in a series of moves that began last September, has significantly lowered its target federal funds rate. Indeed, last week, in an unprecedented joint action with 5 other major central banks, and in response to the adverse implications of the crisis for the economic outlook, the Federal Reserve again eased the stance of monetary policy. We will continue to use all the tools at our disposal to improve market functioning and liquidity, to reduce pressures in key credit and funding markets, and to complement the steps that the Treasury and foreign governments will be taking to strengthen the financial system. Notwithstanding our efforts and those of other policymakers, the financial crisis intensified over the summer as mortgage-related assets deteriorated further, economic growth slowed, and uncertainty about the financial and economic outlook increased. As investors lost confidence in the ability of certain firms to meet their obligations, their access to capital markets as well as the short-term funding markets became increasingly impaired, and their stock prices fell sharply. Prominent companies that experienced this dynamic most acutely included the government-sponsored enterprises Fannie Mae and Freddie Mac, the investment bank Lehman Brothers, and the insurance company AIG. The Federal Reserve believes that whenever possible, the difficulties experienced by firms in financial distress should be addressed through private sector arrangements. For example, by raising new equity capital, as many firms have done, by negotiations leading to an acquisition or a merger, or by an orderly wind-down. Government assistance should be provided with only the greatest reluctance and only when the stability of the financial system, and thus the health of the broader economy, is at risk. In those cases when financial stability is broadly threatened, however, intervention to protect the public interest is not only justified, but must be taken forcefully and without hesitation. Fannie Mae and Freddie Mac present cases in point. To avoid unacceptably large dislocations in mortgage markets, the financial sector, and the economy as a whole, the Federal Housing Finance Agency put Fannie and Freddie into conservatorship, and the Treasury, drawing on authorities recently granted by the Congress, made financial support available. The government's actions appear to have stabilized the GSEs, although like virtually all other firms, they are experiencing effects of the current crisis. We have already seen benefits of their stabilization in the form of lower mortgage rates, which will help the housing market. The difficulties at Lehman and AIG raised different issues. Like the GSEs, both companies were large, complex, and deeply embedded in our financial system. In both cases, the Treasury and the Federal Reserve sought private sector solutions, but none was forthcoming. A public sector solution for Lehman proved infeasible, as the firm could not post sufficient collateral to provide reasonable assurance that a loan from the Federal Reserve would be repaid, and the Treasury did not have the authority to absorb billions of dollars of expected losses to facilitate Lehman's acquisition by another firm. Consequently, little could be done except to attempt to ameliorate the effects of Lehman's failure on the financial system. Importantly, the financial rescue legislation, which I will discuss later, will give us better choices. In the future, the Treasury will have greater resources available to prevent the failure of a financial institution when such a failure would pose unacceptable risks to the financial system as a whole. The Federal Reserve will work closely and actively with the Treasury and other authorities to minimize systemic risk. In the case of AIG, the Federal Reserve and the Treasury judged that a disorderly failure would have severely threatened global financial stability and the performance of the U.S. economy. We also judged that emergency Federal Reserve credit to AIG would be adequately secured by AIG's assets. To protect U.S. taxpayers and to mitigate the possibility that lending to AIG would encourage inappropriate risk-taking in the future by that company or others, the Federal Reserve ensured that the terms of the credit extended to AIG imposed significant costs and constraints on the firm's owners, managers, and creditors. AIG's difficulties and Lehman's failure, along with growing concerns about the U.S. economy and other economies, contributed to extraordinarily turbulent conditions in global financial markets in recent weeks. Equity prices fell sharply. Withdrawals from prime money market mutual funds led them to reduce their holdings of commercial paper, an important source of financing for the nation's non-financial businesses as well as for many financial firms. The cost of short-term credit, where such credit was available, jumped for virtually all firms, and liquidity dried up in many markets. By restricting flows of credit to households, businesses, and to state and local governments, the turmoil in financial markets and the funding pressures on financial firms pose a significant threat to economic growth. The Treasury and the Fed have taken a range of actions to address financial problems. To address illiquidity and impaired functioning in commercial paper markets, the Treasury implemented a temporary guarantee program for balances held in money market mutual funds to help them stem the outflows from those funds. The Federal Reserve put in place a temporary lending facility that provides funding for banks to purchase high-quality asset-backed commercial paper from money market funds, thus reducing their need to sell commercial paper into already distressed markets. Moreover, we will soon implement a new temporary commercial paper funding facility that will provide a backstop to the commercial paper markets by purchasing highly rated commercial paper directly from issuers at a term of 3 months when those markets are illiquid.